Welcome to the latest edition of the DBS webinar series, Insurance Insight, where we tackle in-depth topics, dig deep into breaking news, and scour the industry for the people who can give you the information you need as a financial professional. In these sessions, we give you the tools and analysis so you can better understand the products and solutions that will help you help your clients. Now, here's your host, Kurt Fasen, DBS Sales and Marketing Executive.
All right, well, welcome again, everyone, to Insurance Insights. We're so glad that you could take time out of your schedule to join us. And today I'm excited because we're going to talk about a topic that has recently exploded over the last several years. People are realizing that the cost of long-term care is skyrocketing, and they want to be prepared. And in this session, I think it'll be great because it'll help you better understand the different options that are available to you, so you can better advise your clients, as well as make sure that you're up to speed on the changes that are happening in the long-term care industry. First of all, I'd like to take a moment to welcome and thank in advance our panel presenters today. First of all, we have Rob Johnson. Rob is from Lincoln Financial MoneyGuard team. He has been with Lincoln MoneyGuard since 2018. He is a tremendous partner to DBS and has over 20 years of experience in the financial services industry and is currently the sales vice president, and he serves several territories, including Minnesota. Rob, welcome.
Thank you. Appreciate it.
Next, I'd like to welcome Ben Hatch from Nationwide CareMatters team. Ben has been with Nationwide for over 5 years in several different roles and is currently the regional CareMatters wholesaler and covering the Midwest territory, including New York and the New England states. Ben, welcome.
Thank you.
And finally, we have John Thomas from Securian Financial SecureCare. He has been with Securian about 4 years now, and after spending 10 years with another carrier where he focused really just on linked benefit long-term care products in the BGA market, he really is an expert in the field. He has extensive experience not only in long-term care, but also retirement strategies and life insurance. John, glad you're with us.
Thanks, Kurt. Great to be with you.
All right, so before we get into specific, let's talk about the topic of long-term care in general so we all can understand what we need and how important it is that advisors take time to understand what their clients might be facing. Ben, I'm going to throw this one to you to start with. Can you talk a little bit more about why a plan for long-term care is really essential?
Yeah, it's pretty simple, at least from our shoes. It's what it does, or what a long-term care plan does, is it really protects the client's family lifestyle in retirement. In other words, your client doesn't just have retirement income goals, right? They also have a lifestyle goal in retirement and who they want to spend that lifestyle with, right? So long-term care expected costs you're looking at about an 80% increase by 2039. And so that's a number that we probably shouldn't ignore, and we need to start planning on how to hedge against those costs. And we also understand about the amount of baby boomers retiring every day, right? I think by 2030, the 65 and older are going to be all the ages of the baby boomers. And so now we talk about who's going to take care of them, or where are they going to be taken care of? And we all know how supply and demand work, right? When they all rush and all need care, the demand is huge, but the supply is very little. What happens? The costs skyrocket, right? So it's very important that we ask our clients, how do you feel about paying $5,000, $6,000 a month out of your income goal in retirement to pay for some costs of long-term care? They're probably going to say, we didn't have that in mind, right? So having a plan in place ahead of time is really going to hedge against those future costs.
Yeah, I mean, that can be devastating, shocking, and if somebody hasn't prepared, it can really put you in a difficult spot without a doubt. All right, well, there's no doubt that this will continue to be an issue, and it can be devastating for families financially and even emotionally, and also for those that are coordinating the caregiving. Now, when we talk about long-term care and what services are available for those that need it, what are the options? John, you want to take this one and share a little bit about what specifically we're talking about here?
Yeah, absolutely, Kurt. I think, when you hear the term long-term care, a lot of people think nursing home, right? And we talk about long-term care, but what it really is simply is elder care, right? We're all aging. You're born, you start to grow, and then you're aging, right? And we're all going to get to a point where we need some care. And so life happens. We all plan and we think about retirement, and we get to a point where we start to slow down, and we're going to need some help. Right, and so that's elder care. That's it's care in the community, and so those are things like our loved ones coming around us, our spouse, our kids, extended family in the community providing care, and it's also traditional qualified care sources, things like nursing homes and assisted living and adult daycare. Right, those are part of it, and so what it's not, I think, is rehabilitative care. And so if you think about it from a government perspective, the government qualifies what is long-term care. And they say to be a qualified long-term care a claim, if we're talking about insurance products, it's an individual that can't do 2 of 6 what they call activities of daily living. You've probably heard of those or heard that terminology, right? It's things like being able to feed yourself, being able to dress yourself, get on off the toilet, right? Really care for yourself. And then there's also what they call instrumental activities of daily living, shopping for yourself, being able to cook for yourself, driving, right? Getting to and from doctor's appointments. So that's all part of the elder care situation. But from a government perspective and insurance claims, if you can't complete 2 of 6 activities of daily living, or you have a cognitive impairment, Alzheimer's or dementia. Ben was talking a little bit about the risk of long-term care, right? Looking at Alzheimer's and dementia, that risk has increased by 70% over the last decade. And so that's a growing part of it. I'll throw this out there. AARP does a fantastic study on caregiving. It's probably one of the best studies on comprehensive caregiving, looking at what caregiving looks like in the United States and the risk and the cost of caregiving. And so I would check that out. But a couple of things from that report, there are roughly 15 million folks in the United States that are receiving care, right? 90% of that happens at home or in the community, and about 10% in a qualified facility like a nursing home. And it's not just limited to elderly. There are roughly 50% of folks that are recipients over 75, but 40% are between the ages of 50 and 75. So it's not just a conversation for elderly folks. There are folks that, have a stroke. The incidence of heart disease is causing folks to need care earlier, right? And so it is a conversation that we really need to have with everyone.
Absolutely. So I like the term you used, elder care, because it signifies more dignified existence, if you will, and kind of changes how people think about it. So appreciate that, John. So Rob, I'm going to turn this over to you, and I want to talk about, all right, so we talk about options for long-term care, and but how are people traditionally paying for this? So, whether you need care in your home or you need care at a qualified facility, what are some of the things that people go through to be able to afford such care?
Yeah, and then the number of options has changed quite a bit over the last 40 years. So if we think about the typical ways that people are looking to put a long-term care plan in place, most often, and what most advisors have thought about, is that traditional or standalone long-term care option. Those first started back in the early 70s. That space has changed quite a bit. There used to be 100 plus carriers. Today, I think there's about 12 different LTC carriers. The advantage there is that is the lowest cost entry into having long-term care or extended care coverage. The other option that we often see is a life policy with either an LTC or a chronic illness rider. That we're seeing that fairly often. The primary objective of those types of solutions generally is the life insurance, the legacy protection being the number one reason they're buying that type of solution. And with a secondary reason, almost like getting the fries with the Big Mac, is having that LTC or chronic illness rider. it is important to understand the differences between LTC and chronic illness riders, and that's where my friends at DBS can help you understand which carriers offer which types of options. Generally, LTC riders, that condition does not have to be permanent, or with many chronic illness riders, that condition or that 2 out of 6 ADLs would have to be a permanent condition. Next option is what we're all here today. In fact, all of our carriers offer those permanent policies with those LTC riders, but what we're talking today about is the hybrid LTC solutions. Those hybrid LTC solutions, those offered by my friends here at Nationwide and Securian and Lincoln, have evolved quite a bit. Now we see about 9 different carriers in this space, and they've seen a variety of, those products have evolved quite a bit, especially in the last 10 years. And what's helped with that is competition in this space. And then finally, the other way people are funding this more often than not is those self-funders. Self-funding is a plan for long-term care. We all believe that there are smarter ways to self-insure, and by leveraging those dollars to provide tax-free benefits. So those are the main 4 options that we're seeing for those looking to provide dollars set aside to pay for long-term care.
Yeah, and so so that's a good overview of all the different ways. And a lot of people that I've talked to outside of our industry say, oh, I'm just going to pay for it. But let's dig just a little deeper, because we know self-funding is very detrimental to a retirement portfolio. And a traditional standalone, as you said, that has some drawbacks. So I do want to focus a little bit on, you all have riders, and you all have, those of you that are joining us today, you all have riders on your life products, and you all have hybrid products on your platform. Let's start with Ben. What's the difference in basic terms between a rider and a hybrid solution?
Yeah, absolutely. So the basic terminology that you can think of when you talk about a long-term care rider, Kurt, is that fact that it's tied to a life insurance contract, right? And it's usually in addition to a life insurance contract. So it's something that you add either at the time of application, or some carriers will allow you to add a long-term care rider to an already existing life insurance application with possibly some additional underwriting. So that generally just accelerates your death benefit. Okay, that's all you get. And so as Rob was saying, it's mainly for legacy planning. So when you're going into doing some planning and you think life insurance first, you think death benefit, income replacement, something that I need because I know that I'm going to pass away at some point, but to protect an unexpected death, we think life insurance first. So you're going to get a big death benefit pool, and then you can add a long-term care rider here down the road or right away, just for that just in case type of moment. For our asset-based LTC, it goes a little bit longer than what a death benefit does on the long-term care rider. So with the asset-based LTC, it's still tied to a life insurance chassis, right? But it's a complete opposite of what a life insurance product offers. You're going to get a small death benefit, but in return, what you're going to get you're going to get is what's called an extension of benefits. At least from a Nationwide standpoint, we call it the extension of benefits. I know there's other carriers that call something different, but the extension of benefits is exactly how it says. It's an extension, goes beyond your death benefit, and that's another pool of money that the client has access to. And generally, long-term care with an asset-based LTC, you're going to get more long-term care pool versus the rather of a life insurance with a long-term care rider. With the two differences outside of what I really mentioned already is the underwriting is one of them. Life insurance, as you know, it's more mortality-based underwriting. So you're going to go through full underwriting, and it can be paramed, it can be records and such. And I know there's carriers out there such as Nationwide have what's called intelligent underwriting to really speed that process up with our healthy individuals. But generally, it's full underwritten business. With our asset-based LTC products, it's on morbidity. So you're going to go through a phone interview that talks about the chances of you needing some sort of help down the road instead of some sort of chance that you're going to pass away. And so these interviews tend to be shorter. They're 45 minutes to an hour, at least on average, depending on the client's health and how prepared they are for that interview, of course. But that's about it. And then some carriers will, such as Nationwide, will order records if they need more information, but it's generally on a very limited basis because the products just aren't priced enough to order all these records. So a very limited basis. And last but not least is the inflation option, right? So that's the huge advantage of these asset-based LTC products, is that most carriers, all carriers pretty much, who offer these type of products, have 3% simple, 3% compound, 5% simple or compound, and some have index options that really grow your long-term care benefit, which is extremely important with the way the cost of care is going up, right? So long-term care riders, unfortunately, don't do that. They just have an acceleration of 2%. For Nationwide, we have a 2%, 3%, and a 4% option, but it doesn't grow.
That makes sense. That makes sense. So, John, why would we choose a rider on a product rather than an asset-based long-term care product from your standpoint?
Yeah, right, Kurt. I think Ben really set the stage well for talking about the two different options. And when I think of and when we think of asset-based long-term care products, those are really for folks that have assets and they're willing to reposition some of the assets or the extra income that they have into a solution for long-term care. The goal with asset-based long-term care is long-term care planning. As Ben said, the asset-based product is built on a life insurance chassis, but it's really not for death benefit or protection or legacy planning. It's used for the tax benefits of life insurance and to provide things like death benefit tax-free and long-term care benefits tax-free. But the goal of that product is long-term care benefits. Reasons to choose the rider on life insurance. I think really it is if your goal is legacy planning or protection planning, or you need a death benefit. I really think of that solution as a fantastic transition benefit, right? So you have someone in their 30s and their 40s and they've got a young family or they're working towards retirement and they need a death benefit, right? They need life insurance. You can add that long-term care rider for a really nominal cost, so that cost is quite a bit less than maybe an asset-based product. So for a nominal cost, you can add that rider to your life insurance. And then as you age and you mature and you get toward the end of your career, maybe you don't need the protection anymore, right? And so that policy becomes a transition. It transitions into providing for long-term care or elder care down the road. And so it's a great product to buy when you're younger, when you're in that accumulation phase, when you have that protection need, and then keep it around and use it and transition it for later in life.
That's perfect. So Rob, talk a little bit about what benefits exist for an asset-based long-term care style product.
Great. And what I love about asset-based LTC solutions, and really all of the ones we're talking about today, is they provide tax-free dollars to allow loved ones to supervise that care rather than be the provider of that care. So all of the asset-based LTC solutions will offer tax-free LTC benefits. That opportunity to leverage those dollars 2 times, 3 times, 4 times, and leverage those into tax-free LTC benefits. They all, depending on the carrier, offer inflation riders, or depending on, they might have growth through market performance. So they're going to have a benefit that's going to continue to grow to keep up with that rising cost of care. I mean, just last year, we saw the average cost of assisted living go up 6%. So if we're thinking about individuals typically looking at asset-based solution, maybe being around age 60 and not likely to need care maybe until they're in their 80s, having an inflation component or a benefit that's growing is key to any type of solution. These asset-based LTC carriers, all of us here, offer care coordination services to help the insured and their family members find that care, find care in the area, know what options are available, understand the costs. Each of these carriers offer payment flexibility. For a lot of people, and I still get this, even though MoneyGuard's been around for 33 years, people still thinking of it as a single pay solution. There are there's more flexibility than we've ever seen. So whether it's a single payer paying over 5 years or 10 years or to age 75 or even longer, there is flexibility there that we've not had in the past. these policies are all comprehensive. So we talked about it before. John did a great job. Often we're thinking LTC being that nursing home coverage. Last year at Lincoln, only 11% of our claims were paid to a nursing home. This is primarily care provided at home or an assisted living facility, but all of these policies are going to cover regardless of what type of setting you're in. And that may be different than what you've seen in the past. Back when I started, there were nursing home only policies, home care only policies. Mm-hmm. All of these carriers have evolved and now provide comprehensive benefits. There's also the ability, and it's often overlooked, is that ability to reposition an asset and fund it via a 1035 exchange. We see that here at Lincoln about a third of the time, where either a portion or all of the premium is funded from dollars that it was previously in a permanent life insurance policy that they had in place while they were paying off the mortgage or while the kids were in college. Now their next biggest concern is an extended care event. So that ability to fund via 1035 is always a great opportunity, especially when we're doing the policy reviews, when we're meeting with our clients. And lastly, there are two main types of policies. There are reimbursement policies, there are indemnity style policies, and now there are a combination. There are carriers that offer features of both types of policies. So those are the biggest features of asset-based LTC.
Now that's very, very helpful. And you're right. I mean, I know of cases personally where people have looked at what I'd call sleepy asset life insurance policies and said, I don't really need it for what I bought it for. What I need now is I need something to address when I get a little bit older, right? All right, this is probably a good time for us to pause and switch gears just a little bit. And I'm going to invite each one of you to just take a moment to talk a little bit about your specific offering, what you bring to the table. Now, you know, those of us joining on this call, you know that, you know, DBS has, well over 30 different carriers. And we selected these three carriers specifically because they have a nice cross section of what they offer in this specific space. So hopefully that'll give everybody a bit of an understanding of what's out there. So I'm going to turn the mic first over to Ben and talk a little bit about what Nationwide has to offer and why an advisor would want to look to Nationwide.
Yeah, absolutely. So starting off with our life insurance contracts, our long-term care riders on these contracts are offered on all of the permanent products that we have. So you're talking our IULs, our GULs, or VULs, and even our survivorship index universal life case. What's really unique about our long-term care rider is the acceleration options that you have with it. So it does have to happen at the time of application. The client has the choice of a 2% acceleration of their death benefit, a 3% acceleration of their death benefit, and even 4% acceleration of their death benefit. That's very unique, and it also offers couples rates as well with non-tobacco rates on our long-term care rider. From our asset-based long-term care plan called CareMatters, it offers a few features that makes us stand out. One of them is us having the ability to separate out our long-term care premiums from our life insurance premiums. So not too many people know this as of yet, but we're able to separate out these. And so by separating out these, you're not actually paying this cost deducted out of the cash value. So you're avoiding kind of a cost gain since these generally lower the cost basis of your product. You're actually paying for the long-term care premiums yourself out of the full premium amount. Therefore, you actually can take a tax deduction of the long-term care premiums. Now, even though individuals can have this opportunity for a tax deduction, there are some a little bit more strict restrictions on how they get to that. It's really attractive with business owners. I have conversations all the time with our business owners on how they can offer a long-term care plan to either their employees or even purchase them one on themselves and buy it through the business and get a certain tax deduction. That's very, very unique, and in this linked benefit space, at least, very unique, not only to Nationwide, but to other carriers out there as well. And then there's also what's really innovative, and it's not very unique to Nationwide right now, is what Rob and John were mentioning, is the fact that we offer a cash indemnity style policy. Those who don't recall, Nationwide was actually the first in the market to offer a cash plan back in 2013. And so don't mistake us for having a very small experience in the long-term care space, because we've also offered LTC riders on our life insurance contracts for 20 plus years. And the very unique thing about these is that they all paid cash benefits. So that gives Nationwide a really, really unique advantage of having extensive experience, not just in long-term care in general, but paying a cash benefit. And lastly, what I will say is, I want to talk a little bit about customer service, because I think customer service really is the forefront of every company. A lot of people view a company based off their customer service, not necessarily what the product they offer. In 2020, Nationwide was ranked the third ranked in the JT Power rankings. And so if you think about what really happened in 2020, right? I mean, the country was turned upside down. I'm sure all of our phones were ringing off the hook with our members really calling us saying, you know, how can I get some money out of our insurance policy? Is my insurance policy okay? To still be ranked number 3 during that time, I think speaks volumes of what the customers or members really think about us.
No question, no question. Well, thank you. That is compelling, and you know, congratulations on such a great year at Nationwide. I know that the market is really resonating with your story. Let's turn gears over to Securian and let John have a turn. Tell us about your products and what makes Securian stand out in this area.
Yes, thank you, Kurt. And I'll start by just saying, you know, many of you may not know us as Securian, or you may. We are a Minnesota life insurance company, and so you've probably heard us under the banner Minnesota Life Insurance Company. Securian is the umbrella company of Minnesota Life. So Minnesota Life has been around for 140 plus years. We are a mutually held company, and we've got fantastic financials. We've just had our financials affirmed this past quarter. We've got a Comdex of 96 out of 100, and so a really well-rated company. And I think back to, you know, long-term care insurance companies and the long-term care insurance business. If we look back, you know, several decades, there were 50 plus traditional long-term care carriers in the market, right? And there were challenges. Many of you are familiar with those challenges, to where we're down to just a few traditional long-term care carriers, right? But as life insurance carriers have evaluated the long-term care opportunity, carriers like Securian, we see a significant opportunity to use life insurance products, life insurance chassis, build them on actuarial assumptions of life insurance with those guarantees, and also protect the solution. And so many carriers are getting in the game, like Securian. We entered the market in 2017, and we see a significant opportunity here. But I think I start with that really just to say, as you offer a product to your client, really our consumers, you want to know that it's a solution that's going to be around in the future to protect your client, right? And that carrier is going to deliver on their promise. And so Securian's a fantastic company. Lincoln's a fantastic company, Nationwide as well, and additional life insurance carriers are getting into this game to deliver and offer products to this market. And so I really start there. But Securian, we offer a chronic illness riders on each of our traditional traditional life insurance products, and so allowing you to accelerate that death benefit to use towards elder care and long-term care. We also offer a somewhat unique rider on our term products. It's a chronic illness conversion agreement that really allows you to lock in your insurability. So you can buy a term product and be underwritten for long-term care risk on that term or chronic illness, and then you can convert that to a permanent product in the future and have your insurability already bought, right, or already approved. And so you convert to a permanent product and you have long-term care on your policy. So that's somewhat unique that we offer in the market. And then we offer an asset-based product called SecureCare, and that's the product I talk about primarily. And I think generally what we do well is tell the story of repositioning assets. And we have a simple and transparent story. And when we designed this product, that was really what was in mind, is to offer to the market a simple, transparent product that is fully guaranteed, offers the guarantees of death benefit, liquidity, long-term care, right, and be transparent in what those benefits are. And so we have a simple illustration, fully guaranteed, and all of those benefits are very clear. But the story we tell well is that when you present this solution to your client, right, we're talking about retirement planning and how this fits within their investment, right? And we'll take let's say a 60-year-old that is looking at this solution. They're nearing their retirement age. And they're thinking about long-term care planning, right? The question that we often talk about is why is this type of solution better than self-funding, as Rob talked about earlier, right? Why shouldn't I just leave my investments and use my investments to pay for this risk down the road? And I think the story we tell well, based on the leverage we provide and the pricing we provide, is that if you make this investment at 60, you use the power of insurance leverage, particularly with the inflation options we offer. By 80, 85, you're going to see a return on investment that is 9, 10% tax equivalent yield compared to what you'd earn in the market, right? And so the power of leverage, insurance leverage, really is that you'd have to earn 10% to match the benefits we provide in these type of solutions. And so that's a powerful story. I think it helps folks understand why insurance should be part of the planning conversation, and not just, you know what, I've got these investments, I'll take care of that risk when it happens. But this is a tool, we offer these tools that really help folks maximize their investment, maximize their retirement portfolio to make sure they're protected well.
Yeah, and John, that's great. And I think a lot of people, they, you know, as you say, they take that wait and see approach, and that can be dangerous. And by utilizing products like you have at Securian, and by the way, congratulations on your year. You guys are having a tremendously big year as well. I think that allows people to have a little more certainty going into those golden years, if you will. So
that's right.
Rob, let's talk about MoneyGuard. Talk about Lincoln MoneyGuard. What makes it unique? What situations would it work best for a client?
Great. You know, as an industry, we've been stuck at about a 10% market penetration for years. And that's even with new carriers entering this hybrid space. We've seen carriers move from offering single pay to flexible payment options. We've seen these policies evolve and open up additional opportunities. We've seen carriers like my friends from Nationwide and Securian today enter with indemnity style options. Lincoln's flagship MoneyGuard 3 product is our fully guaranteed solution, and which has been the standard in the industry, which all others are compared. The challenge for life and LTC carriers, especially in the last year and the last number of years, has been that persistent low interest rate environment.
Right.
Now in our 33rd year of offering MoneyGuard, Lincoln's made the decision to offer an alternative solution to MoneyGuard. So in addition to our fixed version, the fully guaranteed MoneyGuard 3, we now offer a variable version of MoneyGuard after really asking for feedback from agencies like Diversified Brokerage Services and the advisors that have used MoneyGuard for years. So that new VUL chassis offers a number of new key features that we believe will really help grow the LTC space. That's ultimately what our goal is. Mm-hmm. So key features of MoneyGuard Market Advantage are uncapped growth through participation in the market, opportunities to invest those dollars with BlackRock, Fidelity, Vanguard, all American funds. Those are all options when we're looking at this type of solution. We also provided downside protection, including 2 guarantees. We're offering a baseline guarantee and then that opportunity to have annual lock-ins on every policy anniversary with a multiplier at the time of claim. We're also offering preservation of death benefit like all of the carriers do, but what the challenge has been is now in this persistent low interest rate environment, we're often seeing death benefits just about equal to what they had paid in. Well, when we're thinking about these types of asset-based or hybrid solutions, typically we're seeing more of that affluent client who says to us, hey, you know what, I paid in $75,000 over 10 years. If I don't need this, my death benefit's $75,000. Now, compared to a traditional LTC solution, that's a good story. We've taken that use it or lose it off the table. But when we think about those self-insurers, they say, you know what, I gave the insurance company X number of dollars, and if I never need this, I'm only getting back what I paid into the policy. Now, for a lot of people, that's a good trade-off in exchange for those guarantees that the carriers are providing. But we're seeing more people say, you know what, if the death benefit was a little more meaningful, this would be a solution I could hitch my wagon to. So MoneyGuard Market Advantage typically will offer a death benefit of 2 to 3 times what they paid in.
Wow.
What you're also going to see with MoneyGuard Market Advantage or our flagship MoneyGuard 3 product is a 0-day elimination period. We're the only carrier in this space that has a true 0-day elimination. So once benefit eligible, your benefits will be available for day one for nursing home, assisted living, home care, any benefits right away. And then finally, streamlined underwriting. Now, all three of us, our carriers, offer streamlined underwriting. What makes Lincoln unique, and is how we've changed over the years, is now we also offer an option so everyone 60 and younger will have no APS, no paramed exam, and no phone interview. So 60 and younger can answer all their health questions online, at home, on their own schedule, start and stop the process. And we found, and for anyone that's done asset-based LTC in the past, you know, that phone call lasting 45 minutes to an hour, it can be nerve-wracking. It's not always the easiest thing. And you don't have the ability to kind of say time out halfway through. Our ability to offer that online PHI, really for everyone can do the online PHI now. We only require someone to jump on the phone if they're 61 to 70, of which all of us require a cognitive screen. Lastly, one of the things we do best is we're not outsourcing our claims. We have a single point of contact. Our Greensboro claims team, again, been doing this for 33 years, offers a single point of contact for the insured and their family members. And everyone has access to a resource called planmyltc.com to help research care in area, find home care agencies, assisted living, nursing homes in our area, start working on what that plan is going to be, set up a network between family members. That's a built-in benefit to anyone that currently has a MoneyGuard policy, even if they bought it 20 years ago, or is going to be purchasing a MoneyGuard 3 or MoneyGuard Market Advantage policy moving forward. So we believe this comprehensive approach to providing two different, both a fixed and variable version, is going to help grow this space, and we're excited to have a second option.
That's great, Rob, and to you as well. Congratulations. I mean, for literally decades, MoneyGuard has been a leader in this space, and again this year a tremendous success winning with your carrier as well. So thank you and congratulations on your success. I have a question for everybody, and you can just nod or say yes or whatever. But Rob just spoke about some assistance, to help find care when somebody's on claim. Do you all have that in your products?
Yes. Yeah, we do.
Okay.
Yeah, and those are so critical for our clients, really.
Yeah, you would think that it's a confusing time, and maybe even another reason to talk towards the, I'll fund it myself. Okay, you're funding it yourself out of your old portfolio, and even if you can take the shock to your portfolio of paying for all of this, do you want to have help figuring out where to go? That's just another added benefit that I think sometimes is overlooked in what the products that you all represent have. All right, I'm gonna send this one over to Ben. Ben, can you just give us, not specific to Nationwide, but more generically, give us an understanding of indemnity versus reimbursement? I think there's a lot of confusion in the marketplace, and people don't really know what that means.
Yeah, absolutely. So reimbursement contracts, I mean, it's exactly how it sounds. You're going to pay out of pocket first, and then these receipts that you send in to the insurance carrier are going to make sure they're qualified expenses. and then reimburse you for those qualified expenses. So obviously, if you're a nursing home, home health care, as Rob mentioned, a lot of his claims are at, they're most likely going to be paying, right? So a little bit of restrictions associated with what you can do with a reimbursement policy, but still, I mean, it covers a lot as far as qualified expenses. For indemnity style plans, at least from Nationwide's point of view, what we kind of preach is just flexibility, right? You don't have to submit monthly receipts or bills and for the carrier to tell you yes or no if it's a qualified expense. And so a lot of people view that, right? They want that full guaranteed benefit to them that's owed to them, and they can use it for whatever they want. And as we all can agree on, that most claims start at home, right? So, and another thing, who is that person that's being the caregiver to start at least? And generally that is the informal caregiver. Our spouse is usually what we like to say. So indemnity plans are very flexible in a way that they can pay for that type of thing. And I'll leave it here, as I mentioned earlier, with the baby boomers all needing care at some point. We're looking at in about 3 years, we're estimating around 120 million baby boomers needing some sort of care with our home health care agency, and the supply and demand that really skyrockets the price, right? So a lot of these baby boomers are going to be left, what about me? Where am I going to be taken care of, right? And so very important that these people are going to be taken care of by unpaid caregivers, right? So these cash plans are extremely flexible, and if you are a huge believer in that informal caregiving space, cash plan is very important.
So let's go real quick. So Nationwide, you have, or Ben rather, you have an indemnity program, correct?
That's correct.
And Rob, what about at Lincoln?
Yeah, so our flagship product, MoneyGuard 3, has been a reimbursement policy. MoneyGuard Market Advantage actually offers the flexibility to have both reimbursement and get up to a third of your benefit in cash, receipt-free cash for informal care, including having a spouse take care of you. I think the misnomer about reimbursement is that you gotta get the bill from the home care agency, then turn around and pay them first, and then submit the bill to the insurance company. And those big bad insurance companies are going to sit on it, and then you hope to finally get reimbursed at some point down the road. A majority of our claims are actually set up on a direct bill. I think this is key, that if we can have that home care agency bill Lincoln and Lincoln pay them, that allows the insured and their family members to stay out of the billing process at a time that can be extremely stressful, both physically and emotionally. So if we can allow them to stay out of that process, this is huge, and still have, especially with MoneyGuard Market Advantage, allow you to get up to a 30-year benefit in cash. So there is that misnomer. Know that that ability to set it up on a direct bill is there.
Perfect. John, what about Securian?
Yes, Securian offers a cash indemnity solution as well. So like Nationwide, it is really, I position it as income, right? When you become disabled, when you're chronically ill and you need care, you receive income to meet that need, whatever it is. And you can use that income however you see fit, right? And so that is some of the added flexibility with an indemnity solution.
Yeah, absolutely. So I think the takeaway there is there are different ways to approach this, and it's important that you understand your client, what is important to your client and your client's planning process, and then find the right solution that's going to fit you. All right, we're just about out of time, but I'm going to ask just one last question, and I'll start with Ben. And I'm sorry, not Ben. I'm going to start with as I started with Ben before. I'm going to go to Rob this time, and Rob, I'm going to ask you, and then we'll go around to everybody to give you 2 cents. The hardest part, I believe the hardest part of this entire situation is having the conversation with the client. This is not something people really want to talk about. So Rob, any tips for our advisors that are listening today?
Yeah, and certainly it's out of the comfort zone for many advisors. I like to think of it, narrowing it down to 3 different questions. And again, going back to reminding them that LTC is no longer just nursing home and coverage. But I like to ask 3 questions. 1, what is the plan if experience an extended healthcare event. Just ask them, what's the plan? What asset would you liquidate to cover that long-term care need? Or 3, if either of you were able to need care, would you rely on a family member to be that caregiver? It's important just to get the wheels turning, asking those questions. You know, what's the plan? Which asset are we going to use first? And if they were to need care, who do they want to provide that care? Those are simple questions, and especially depending on their experience. She may have had experience being that caregiver for someone and knows how difficult it can be emotionally and physically. But this is a great way to really just open up the conversation by asking those 3 questions. We don't even have to get into any of the product specifics, but get them talking about it.
I think that's great. All right, John, anything you'd like to add to that?
Yeah, you know, Rob is spot on. I think it's so important to have the conversation. You know, some plan is important. I think, Rob, you mentioned early on, self-funding is a plan, right? And so a plan is valuable and a plan is important. And I think now is the time to have that conversation. Post-COVID, you know, the challenges that we've had over the past year, folks are incredibly interested in talking about life insurance and talking about long-term care. LIMRA, the life insurance research organization, just put out a great study, and they estimate 50 million Americans intend to evaluate adding long-term care insurance in the coming year because of the interest, right? You know, nursing home occupancy is down 20% over the past 12 months, and folks have experienced their loved ones in nursing homes dying, right? Unfortunately, I've had several family members in nursing homes die over the past year, and so all of us have had this experience. It's close to our hearts, and so I think now is a critical time to have the conversation. Not only that, have it with younger folks, right? That same study looks at financial concern index around generations. And so, believe it or not, the millennials and Gen Xers are almost 2-3 times more likely to ask their financial advisor about long-term care versus a baby boomer. So baby boomers, you gotta, you know, drag them into the conversation, but younger folks are willing to have the conversation, and so it's certainly worthwhile to bring up.
Yeah, that's perfect. Ben, any additions you want to add for advice for folks as they're trying to bring this topic up?
Yeah, absolutely. And I think Rob touched on this a little bit ago, but don't bring up long-term care, right? Because they think nursing home, you're going to lose them, they're going to walk away. And as John mentioned, you know, long-term care insurance is not just nursing home insurance, right? It's much, much more than that. You really want to start that conversation with about consequences, you know, about having a plan in place. What happens if something happens where you become frail? I mean, don't say burden, don't say sick, don't say, having Alzheimer's or something like that, because they're not going to think that's going to happen to them. I mean, we always see that 70% number thrown out there, right? You know, what are they going to think? It's not happening to me, right? And so I always like to say that the men buy returns and the women, they're ones buy the LTC, because they really understand the consequences of having a long-term care need. And so make sure you have the entire family in the office, because you'll let the husband speak and then you'll let the wife speak, and the husband's going to listen to the wife. Really, he's going to understand what her concerns are, and he's going to start to think, wow, I need to make sure, not just for me, right? Not just for me, but for my wife, for my kids, what does their lifestyle look like beyond me or taking care of me? Am I going to put a burden on them? Is their consequences going to suffer? Are they going to have to work part-time and not full-time? If I have grandkids, is my daughter going to spend more time with me than her own kids, right? So you got to think about these consequences, and not having a plan in place, a proper plan in place, whether that's asset-based LTC, life insurance with long-term care rider, or some sort of self-funding option, you're going to have your clients scrambling around.
Yeah, no doubt, no doubt. I'll let our guest panelists just take a breath and think about any final words they may have. But while we're doing that, I just want to remind everybody out there that at the DBS website, we put together some resources and tools for you. And this is what they look like. You have the Link Benefit Resource Center, and we've also put together a Link Benefit Training Resource Center, all on our DBS website. So if you have questions, that's a great place to go. Otherwise, just give our DBS staff a call and we'd be happy to walk you through what you've heard today and help you try to understand what may be the best option for you and for your clients. All right, with that, I want to thank our panelists and go one more round robin for any final words. This time we'll start with John.
Yes, thank you, Kurt. No, it was great to be with you. My only final word is to reiterate that last point. I think, all of the solutions in the marketplace today are fantastic solutions. And kudos to Rob and Lincoln for really paving the way with asset-based products. And I think the future is full of innovation. Adding a variable product to the market is a big deal, and I expect a lot more innovation. But it's so valuable to have this conversation. So, whatever product it is, whatever solution, bring it up with your clients, have that planning conversation. It is extremely good work to help our loved ones, our family, our community plan for elder care. Absolutely.
Well said, John. Ben.
Yeah, thanks for having me, by the way. I really appreciate that. And thanks to everyone who's listening in. And you're listening in for a specific reason, right? You either are big components of long-term care planning or you really want to get into it. So thank you. You're the few that really have a strong grasp on why it's very, very important for your clients to have a very healthy lifestyle when that time comes. And so what I will say is continue to talk about it. Don't shy away from it. I mean, states are even paying attention to it now. You see what's going on in Washington right now, right? They're paying a premium tax for a very short-term plan, not very long-term. And so other states are following. And so you need to step in front of this, have the conversation with your client so they know what to expect. Because when they get that bill in the mail or get that notice from the state in the mail saying you're going to be paying a certain tax for long-term care, they're probably going to come to you asking, why haven't you told me this before? So getting ahead of it now, start talking about it. Don't bring up long-term care, just bring up being frail in case something happens in retirement. How can we protect your income in retirement and your lifestyle? And it'll be smooth sailing from there.
That's fantastic. Well said. And Rob, bring us home.
Yeah, I mean, John and Ben, I appreciate you guys joining. I mean, Nationwide and Securian and Lincoln, the ability, even though we're competitors, that ability to, when each of us do well, it pushes the other to come up with new solutions. And I'll just close by saying, Diversified Brokerage Services, that case design team that is unlike any other in the industry. I had the pleasure of working with case design sales teams from across the country. And the folks that they have there, the knowledge of those life and LTC riders, those chronic illness riders, the asset-based solutions, they are second to none. So I would feel confident that not only they're going to recommend the correct solution, but be able to jump on the phone with you and your client to help explain that. They are second to none. So I feel really confident. I would recommend my own family to work with that team there. So I appreciate the opportunity to join this group today.
Rob, you're too kind. Thank you so much for those kind words. Yes, we have a deep bench of a lot of experience, many of them well over 12, 15 years of experience in case design, and we have a lot of people standing by. So with that, I want to again thank our panelists and thank you for joining us today. And we look forward to seeing you on one of our next calls. And until next time, be well and stay safe.